Welcome, guys. Nice to meet some of you. I haven't met all of you in person, but we've been chatting. So last year, actually, this was 7 months ago. COVID kind of messed our schedule, with the conferences. So 7 months ago, I had pretty much the same panel, different people, talking about managing VC in a downturn. This was only like 3-4 months after public markets started crashing. It was obvious something was going to happen. We didn't know, how long it's going to take. So I'm not going to spoil Abe's talk later. You should all stick around for that, about where are markets now. What I want to ask you guys across, again, different geographies and different stages, what you're seeing now in the market. Are deals being made? What sorts of deals? Are the best companies, sitting on cash and not looking out to raise? Let's maybe start with Jeremy, because you're like early stage.
Hi everyone. I guess it's an interesting moment to be in this ecosystem as a VC or as an entrepreneur, actually. What we're seeing right now in Europe is actually nothing is happening at Series B stage and plus. It's a bit, we'll see what will happen in 6 months, but right now, really, nothing is happening. At A stage, what we see is something quite interesting. There is a strong dichotomy between companies. If you're a perfect company, you raise money very, very quickly, still at very high valuations. If you have one problem in your company, whatever the problem, it's very difficult to raise money. And at seed stage, it's 2021. So a lot of dry powder, a lot of money in the market. If you have a good funding team, a good project, you can raise a lot of money at very high valuation just on the deck. That's what we see everywhere in Europe.
Ross?
Yeah, I think we're seeing a lot of the same dynamics. The numbers are telling the slowdown in late stage is real. And, until the IPO market comes back and people are forced to go public and face the music on the public side, I think they're going to hide out. And, a lot of them raised cash in 20 and 21, a significant amount. They can stay on the sidelines, kind of keep their head down, focus on maybe changing the profile of the company to get public. And that has just a cascading effect. It's going to take time for those companies' valuations to reset, which kind of drives down earlier and earlier into, each subsequent stage. And then, in the early stage, you're seeing everybody focus more earlier, where the growth can help kind of cure the valuation resets. And I think this is just, a healthy process, albeit painful, that just is going to take a while to sort out. But it's certainly a time, the later stage of a company you are, the more of a slowdown there is in funding activity at the moment, for sure.
And perhaps you touched upon valuations. It's a pretty hot subject, especially for us at Vintage. We see, some companies, we have multiple funds of ours that are invested, and we see what they hold their valuations at. Sometimes it's not the same in every fund. So maybe let's, thinking of your more mature companies that raise at crazy valuations or, very high valuations. How are you thinking about that? Are you, changing your book value?
Yeah, I'm happy to take that. So as we look at our more mature portfolio, so 80% of our entries are at the Series A or B stage, and then we continue to double down on our businesses throughout their life up until either they go public or are acquired. And so for our businesses that have raised, let's say, Series Ds or Es, or at least have gotten to, let's say, 100 million in ARR, our valuation policy has always been not simply to mark up to the most recent private round, but really actually take longer-term historical public multiples as one of the key inputs. And so I would say ours, we didn't mark up all the way in the last cycle, in the last kind of 2 years, but we were quite proactive as the public market changed as a result to mark down. And so in our 2017 vintage, which is right, is about 5 years old, as an example, the largest value driver in the business that we deployed the most capital in, even before the public market all the way went down, we proactively marked that down about 30%, because that's what we were seeing for given kind of where the markets had gone, where they needed to then be reset.
Yeah, I mean, you heard a lot here. Same case. So, we are a crossover fund, so we have a big exposure to the public market, which of course we adjust accordingly. I look after and run our Velocity Fund, which focuses on A through C stage companies. In that instance, I feel like there's been, if you look at the valuations, it's sort of gone. Well, actually, the Series C and A is actually up if you look across what it looked like at 21. But then you have, a drop from 10% at the Bs, 20, 30% at the Ds and beyond. And then you've seen in the public markets, there's some, interesting even further drops in some instances, 70%. So, I think, but the bigger point is just how loose are people with marking up their positions.
So if you're not making any new investments, it seems like, or at least most of you are not, maybe talking about your existing portfolio and what's the most important piece of advice you're giving your companies at this stage. It feels like to me as I've only been in this business for like 20 months. It seems like it's a pendulum swing of like, okay, growth, and now it's like all just like, don't burn any cash, which seems kind of extreme. The best companies to grow have to spend money. So how are you, what are you telling your companies?
Yeah, I have a little bit of a contrarian perspective to that. I actually think companies now should be investing more. I think they should do it judiciously. But, this is a moment in time. And I think most of what's happening is a re-rating in valuations, not fundamental performance. So you still have companies, half the S&P beating expectations. You have IT spend, which is the most important, at least for enterprise software, is expected to increase next year 5%. So I think companies should take advantage of the situation. Most importantly, investing in product, their core product. They should avoid things like selling to customers that are, or selling to verticals where customers are hurt. So, if you have FX exposure or lending exposure, and then above all, your team. So I think the missing piece in all this is the big public companies or advisors, they're underwater because of the valuation. So I think it's a great opportunity for our own portfolio to go after talent. They can get great executives, they can bring them to their board. So I think it should all be done judiciously, but I think it would be a mistake to overreact to the drop in market valuation. But you do need cash. So like that, I think the most important is to have cash to do all that. But other than that, I wouldn't overreact too much to one degree.
Yeah, and one thing just to clarify, I think we're at least fairly active right now. So we've kept as a firm a fairly steady investing pace through 2020, 2021, 2022. Personally, I actually made no new investments in 2020 and 2021. I've made 2 this year, both at the Series A stage. But I agree with much of what you said. I think every company operates in at least 3 markets: a product market, the one we tend to think about, but also capital market and a talent market. Right? The capital markets changed pretty fundamentally. Money used to be really easy to acquire, obviously much more challenging now. But talent, it's actually the best talent market I've seen, not just from an engineering perspective, but from a go-to-market talent perspective, maybe in the last 6 or 7 years, not just 3. And so where we're spending time with our portfolio is, yes, making sure they're focused on building product, defensible competitive advantage, but also using this moment in time to really focus on building out not just the team they need for today, but the team that they're going to need as at least volatility settles down a little bit in the market, and they have the opportunity to push a little bit harder on their go-to-market.
If I could add to that, I think this is a time to, in our portfolio, we still have an offensive mindset, but I think offense is changing, and you need to recalibrate how you think about playing offense in this market. And a lot has to do with, I think you could potentially just put the pedal down on all respects with your business in 20 and 21. Costs were not a factor. IPO support, future capital support, all was taken as a given. So I don't think the pendulum has swung all the way to defense and put your head down and huddle up. But I do think the definition of offense and how you prioritize your bets and how you measure them and define unit economic success and long-term profit potential now underpin the offense that you want to play. And you still want to be on offense. And this is where investors like ourselves have a big impact in the boardroom, helping define what that offensive game plan is. And I think, it really depends what stage of company you're at. And again, what type of, future capital support you're going to need for that offense, or if you're going to go public. If you want to go public in the next 12 months, it's almost a fact that you're going to need a positive rule of 40. This is the new, en vogue term. This means different things and can be debated, of course, but you have to work backwards if you want to be a public company now for the profile you're going to need to get public support and investor appetite. And that will, again, inform what outcome you're going to need to drive to and in what time, which may not be the right answer. But if you do, and a lot of companies are thinking, what do I need to do to get public? That's going to change how you think about playing offense and what type of profile you can, put forth for investor support in the next 12, 24 months as we navigate this time.
I completely agree. I mean, with what you said, maybe to give an early stage perspective, I guess that the last years, in the success equation of any company, we kind of factorized the idea that downstream financing was guaranteed. So you scale, you have money, and you scale more, you have more money. That's it. It's very easy, like it's 100% chance. Now it's a bit different. So what we say to our companies, of course, they have to invest money and they have to be on the offense and being like very aggressive when they develop the business. At the same time, I think now they really need to work on the healthiness of unit economics, because now for the bigger guys, they want to see something very clean when they just look at the engine of the company. They want to see like healthy unit economics. They want to see your ability to scale in a good way. And so right now, when we look at any company and when we discuss with our portfolio companies, we are focusing on this. So you have money, you have to invest this money, but now that the downstream financing is not guaranteed, you have to be a very good, healthy, clean company, even if you have to maybe reduce a bit the growth rate.
And did you change your strategy at all? So, for instance, reserve strategies, touching upon what you just said, that follow-on money is not guaranteed and might take longer. Did you look at revising your strategy?
So that's,
as an LP of yours, I'm asking.
No, you're right. That's honestly, this is a difficult question because it's quite difficult actually to change your reserve strategy on the go. So what we're doing right now is actually we are reducing a bit what we plan for the best companies. It's a tricky question, honestly. I think there's no perfect answer. But let's say when we have the ability to invest, I don't know, like or prioritize 15 million for a company, we'll try to invest maybe 12, just to keep those 3 million euro on the side, because we know that some companies will need a bit more runway, and those 3 million euro can be a game changer in their ability to reach success. And we think it will have a strong impact on our performance as a fund. So we're trying, I mean, honestly, it's almost a daily reasoning. We're working on, honestly, the real answer is we're working on the reserve strategy every quarter right now.
Yeah, that makes sense.
I think it's a great question. For us, we've typically reserved 50% of capital for follow-ons, although historically, and we've continued to heavily concentrate that capital in a subset of the portfolio. I would say our strategy absolutely changed in how we managed our existing portfolio from a capital perspective. Really going into 2020 and 2021, we were net sellers, and now we're doing the opposite. Right, we're much more active from an investment perspective than we were because, as we shared, the end product markets are great, right? The global spend on software is twice what it was 5 years ago, is still growing, despite the economic headwinds that we see more broadly. And so I think now is probably the best time to be deploying capital both into one's portfolio and into net new companies.
Actually, the same was true when COVID hit, right? The rush was say, hey, can you get 2-3 years of cash? If you need to get debt, you need other access, just make sure you have that. And so we've done the same thing. We wound up doubling down in a third of the portfolio, so doubling our position sizes. But yeah, I think for the most part, that's the real question. And you should have either a reserve or a strategy with partners and colleagues to make sure that that can be facilitated.
Yeah, we've been talking with our portfolio companies. You mentioned change in strategy. I think it's incumbent on companies right now to, and again, I focus more on the later stage, so this is not really talking about seed, Series A, but a later stage company, I think it's incumbent to think about what is the plan you can make right now that gets to cash flow break even. And then I think it's important for founders and companies to know that that doesn't necessarily need to be the plan you follow, but this is a time to be very dynamic in measuring investment and syncing with the board and your capital's, investors around continuing to sensitize where and how you keep kind of the pedal down. So you want to have a plan to be, to control your own destiny if possible. For some companies, that's going to require more adjustment than others. But if you can start there, and these are the conversations we're having a lot of right now, then you can be selective on continuing to keep, the offense. Again, what I was talking about before, how much offense you can play while still controlling your own destiny and not running out of cash. And you hope that you will continue to be successful playing as much offense and being as aggressive as possible while still not losing sight of potentially losing how to control your own destiny, facing a down round, needing to step in and find other less agreeable forms of financing.
Maybe one last final question about the opportunity ahead. So now, as you all touched upon the tourist capital going away and the kind of real investors, not real, but the more experienced or more domain-specific investors remaining. It is actually a good time to get aggressive, as you all pointed out. And I'm wondering if there are any. So we've all done SaaS and cyber and dev tools. I'm wondering if there are any non-obvious sectors that you guys are looking at, that you guys are excited about?
I don't know if they're non-obvious. I think a couple that came to light as a result of COVID, but we probably should have been thinking about for a long time, is both healthcare and supply chain. At least as far as the U.S. goes, our healthcare system is more reactive versus proactive. I think the same is true for supply chain. Look, I think that's kind of the future for the next 10 years. I'd also add life sciences to that. So those are a couple pockets beyond the obvious of your application and infrastructure side. So, and then I think cross horizontally, AI ML will be a horizontal tool, but also an ingredient in probably every major tech company. So the way they choose to go about that will be fairly compelling.
Yeah, I would say in a world where capital efficiency is increasingly important, a trend that we've been excited about for a long time, we talk a fair amount about is this idea of product-led growth, or a software company, or more broadly a technology company, being able to leverage its product as opposed to its people as the primary go-to-market mechanism for that business. I think we're still pretty early in the transition from sales-led and really kind of human-led go-to-market to increasingly product-led go-to-market. And as the world, doesn't work maybe the same way it did before, folks are increasingly remote, companies are selling and operating over greater distances across more languages. We think that will be a tremendous driver of value, not just in the companies that have been founded today, but really in technology businesses for the next 10 or 20 years. And so we're continuing to double down on the trend and on those businesses.
Yeah, it's a tough question for us because we're so broad. We love almost, if not all, categories of software. You mentioned are you changing your strategy at all? We're happy we focus on, for the most part, B2B software. We just continue to be more and more excited. The worse the environment gets, I think we're equally as happy that we continue to have invested in software and focus on software for the reasons that you guys mentioned around the macros. Software can, very resilient, can be, defending and supportive of an inflationary environment. One area that we're particularly excited about, I think, is looking at how maybe systems of intelligence are being layered upon traditional systems of record, and AI/ML is helping drive a lot of that and making, take your ServiceNows, take your Salesforces. There are layers being added around these, core pillars that really are starting to take the lion's share of budgets and value prop for companies and make those systems a lot smarter and drive a whole new wave of efficiency and optimization for companies. That's not so much about what you can input into the system, but the system knowing how to optimize and drive your business forward. And that has us pretty excited across multiple categories.
Again, the early stage point of view, I guess that as we don't have a lot of data point when we analyze an opportunity, I guess that we will continue to focus on the best founders. That's it. With this idea that the best founders will find the best industries and the best business models. So yeah, I mean, I guess we'll stay very opportunistic, very open to anything, trying to find those great entrepreneurs and convince them to work with us. And maybe with this idea that for a couple of years, the main rule was, as they said, fake it till you make it. I guess now that we're in a world where you have just make it. So the real thing now is like trying to find entrepreneurs that can make it. So I think there is a strong, a couple of points on top of the best founders, repeat founders. They know how to execute, strong operating capabilities, all those things. But I hope we'll find great founders that will show us the next big waves of opportunities.
So if I have to summarize, I remain super optimistic. I think there's a lot of opportunity ahead for all of us. Thank you guys. Pleasure having you here. Thank you.
Thank you.
Thank you.